A surprise move, many would say. Was this your expectation? Did you think that there was a chance that we could see a cut in today's session?
No, this came as a shock to everyone. I thought they would either hold them steady and maybe issue a statement as to why they held them steady, but a cut was not expected.
Well, Duncan, I mean, looking at that 25 basis point cut and the fact that inflation is currently sitting at 4.5%, you know, the governor also saying that there's no real upside risk to inflation. It's a very different story to what we've been hearing from the investor community. A lot of concerns about food inflation creeping through, and also that, you know, food inflation could be influenced by negative weather patterns as well.
That's very true. I think it looks like the market is reading from one script and the regulator is reading from another. Market expectation from, I think, late last year to early this year is that there'll be an uptick in inflation, partly driven by the weather patterns and the price of crude. So basically, the investor community has been thinking we might see an uptick in inflation, and as such, they would want better compensation. Not a rate cut as we saw today. Well, so, yeah, I find a divergence there.
Well, Duncan, I mean, why do you think that we did see a rate cut? If most are expecting food inflation to be an issue, why do you think that we saw a move on the interest rate?
Well, for a start, we see that the Revenue Authority has not been generating, it's not been meeting its targets. And that could mean that the government may have to borrow more domestically. That is something that most players have been looking at. Secondly, we think the inflation figures that we had from December were looking pretty low as compared to what people are feeling in the market. And now most investors have been feeling like it's sooner rather than later, you'll see an uptick. Crude has been on the rise. The shilling against the dollar has been depreciating quite a bit, meaning that whatever stocks we are bringing in now will probably be much higher. Even the ERC, when they raised, when they first brought down the price of fruit at the pump, now they've revised it upwards. So net, with the state of the weather, we don't expect a bounty harvest, and in fact, we at some point might expect to import some food. So all these factors could lead to an uptick in inflation.
Well, you know, looking at whether this decision was prudent or not, and of course you were alluding to the agenda of the central bank in Kenya at this point, do you think it was a prudent move to cut rates by 25 basis points?
Well, the governor has explained in detail how the MPC arrived at this decision. And to some extent, I think it's more of signaling and trying to cool off the markets. Because if you look at the auctions, the bond auctions from both the bond and the T-bill auctions from September, October, November, December, and even the last one that we had yesterday, there's been an uptick at every auction, meaning that the investors are requiring a higher return. They needed communication and assurance from the regulator that there'll be no change in the monetary policy stance. And so I think the cut on the CBR, as well as the rejection of some bids yesterday at the 10-year, on the 10-year government paper, were meant to cool off the markets, and maybe you could see some sanity creeping back. So I think it was prudent in terms of cooling off the market.
Well, just looking at the 10-year paper that was brought to the market in yesterday's session, I mean, how do you expect the bond market overall to perform in Kenya? There has been, as you mentioned, a lot of nervousness and of course, and also looking at the primary market as well and the primary auctions that occur on a monthly basis. What kind of trends are you expecting into 2011 with perhaps a slightly softer monetary policy stance than previously thought?
Well, that's a tricky one. For one, it was an expectation that the government would borrow less in the second half of their financial year, having front-loaded quite a bit in the first half of the financial year. So there was a view that they'll be borrowing less. But from the look of things, they've still been borrowing huge amounts. There's been a feeling that I mean, the revised budget might add up into the total amount of money they may be looking for. And as such, we expect still investors to remain cautious. There is a view that as we approach the end of the government year, they could ease off on the borrowing, and that could maybe lead to a correction in the rates. But for the first half of 2011, I expect there to be some volatility, and mostly on the medium term of the curve, and also the short end. We might see the rates ticking up. unless, of course, they ease off in the coming months. But as you can see, next month they'll be looking for 32 billion. And I do not know if the trend will continue whereby they're looking for a relatively huge amount as opposed to last year where they were taking less as we approach the end of their financial year.
Well, Duncan, I mean, looking at the bank's prime lending rates and also just keeping in mind that many banks have failed to pass on the incentives since 2009. I mean, we've seen, cuts to the tune of 2.75% since March 2009. Yes, a lot of banks jumped on the bandwagon last year and started bringing down those lending rates. Do you think this is going to create perhaps even more incentive for the banks to relax those lending rates going forward?
I think we reached a point whereby the regulator was really trying to push the banks to cut their base lending rate. And I think there were several forums where the regulator was trying to find out why banks were not going beyond a certain point. And there were quite a number of reasons why the banks did not want to go beyond a certain point. And I think the same reasons are the same. I mean, you look at wholesale money, it's still pretty expensive. You look at the expectation in the market on interest rates, people are asking for a higher return. So in terms of banks continuing to cut rates, I do not see that happening unless there's a massive move. Maybe if you saw a cut in the CRR, and that would mean money translating direct into the market, then you could see maybe the banks also passing on the benefit to their customers. But for the time being, I do not see any significant change with this CBR cut.